Welcome everyone to this quarter's 20 Minutes on the Market. My name is Josh Whalen. I'm an advisor here at Alterra Advisors, joined by Grant Monson, partner and advisor here at Alterra as well. Grant, good to see you.
Yep. Hello. Good to be here.
We are going to cover a couple of key themes as we do each quarter in this discussion. We're going to do a 2024 in review. We're going to take a look at updates on inflation and interest rates. And then the topic of the day, as so many folks have reached out to ask about, has been what are potential impacts on the market, on my portfolio of presidential administration possible actions, including tariff proposals and things like that. So we're going to spend some good time taking a look at that topic. So starting out with a look at the market through last year. So again, this is taking a look as of the end of last year. In the last quarter, we saw some growth in the S&P 500. Remember, the S&P 500 is going to predominantly track U.S. Growth type companies. It's going to track 500 companies across the U.S. market, but really heavily weighted toward those big growth tech, Apple, Amazon, those types of companies. Um, some growth there in the last quarter, some really nice growth over that last year. You can see year to date, everything kind of across the board in terms of US growth, US more income focused, dividend focused type investments. International eked out some gains, a little bit of gains in on the bond side as well. But what we saw was really nothing dramatic in the last quarter. We did see some of that divergence between kind of growth type companies and value type companies open up. But we saw everything grow last year, though last quarter was nothing spectacular, kind of one way or the other. And what's important to remember when we look at benchmarks like this is these are signposts. When we look at your portfolios, what we do is we kind of blend these together, we align them with your goals, and they help us to see if portfolios are tracking in the right direction. So we're not using this solely to make decisions, but they do help us to find out, are we on the right track? Um, an interesting thing to take a look at from our perspective is kind of where valuations sit. So when we look at something like the S&P 500, again, we keep referencing this benchmark, tracks 500 of the largest companies, but really heavily weighted toward those largest growth and particularly tech type firms. Okay, so a lot going on this slide, but a couple things that we see. Uh, Number one is that this kind of general benchmark is trending toward that overvalued category. And so what does that mean? Well, it means that the price that you're paying for those stocks relative to the earnings that they're making is higher than average when we look back historically. But what's interesting is when we look at how it's kind of divvied up, the seven what are called tech titans, so that includes your Microsoft, Amazon, Apple, Google, those biggest companies, their valuations are pretty sky high. And everything else, if you exclude those, is pretty close to historical averages. What this also tells us is that if you are somebody leaning more toward the, let's say, retirement phase of things, your portfolio may not be super heavy in these high growth, more high volatility type companies. You might be leaning more toward companies that tend to be a little bit more stable, your Johnson and Johnsons, your other companies that pay strong dividends. And so what we see is though these biggest companies, these biggest growth type companies, are pretty high on the valuation side, there's actually still seems to be some room to run in some of these other categories. Grant, I don't know if any other comments you would add in as we think about this for client portfolios.
I think you hit the big theme here is your strategy, if it's in a retirement phase where you're looking for stability and reliable income, is going to behave a lot different than the S&P a lot of the time because of those heavy weight to those tech companies. And you also shouldn't look at this and be like, oh my gosh, is the market overvalued and I'm in trouble? Actually, no, that wouldn't be what we'd say actually here. If you look at those numbers, a lot of those companies and those dividend type, more stable companies outside of those tech companies are pretty fairly valued and it's not a real big cause of concern.
Yeah. One other thing that we saw last year was the continued outperformance of the United States over international markets. So again, quite a bit going on this slide. What we see along the bottom can help dissect this and kind of describe what we're looking at here. So on the left side here, in that solid blue line, you have the S&P 500. Again, 500 U.S. heavily weighted towards large growth tech type companies, and then you have a few international benchmarks: Europe, Australasia, Far East, and then emerging markets. This is looking at just calendar year 2024 returns. And what you saw was pretty significant outperformance of the United States over most international benchmarks. And that's there's a handful of reasons for that. Most of which, if you're watching this and have looked at headlines in over the last year, it might make some sense. We still have conflict in the Middle East. We still have conflict in Russia, Ukraine. China, Taiwan issues are factoring in here. So the United States certainly has some volatility when you introduce international investments. You also have international political, any war or conflict like that can weigh those down. So it doesn't mean that your portfolio shouldn't contain these. It just seeks to explain why you might see a difference in performance between the United States as well as or when compared with international markets. And this happens throughout history, right? We go through time periods where international benchmarks trail the US and then catch back up. So again, in an effort to kind of maintain diversification, it doesn't mean we should exclude these. It just means you want to understand what's going on to see if what's happening in your portfolio makes sense given what's happening kind of in the market at large. So Grant, with that, let's turn to economy. Maybe you can walk us through some of the speedometers that we usually take a look at here.
Yeah, so let's look at the economy on one page, if you will. And as we usually typically go through, these speedometers are looking at forward-looking indicators. So think about looking out the windshield of the car 6 to 9 months when it based on what's going on in the economy now, where are things looking in terms of positive, negative, or more neutral. And so when we look at this here, a couple key changes from last quarter. One, fiscal policy went from yellow to green, so some positive movements there. Positive in the sense of how the fiscal policy is looking to impact the economy overall. Business outlook and spending had a slight increase into the green, and then energy costs have been backed off a little bit down, but they're still in the yellow. So we saw some pullback in that area. Now, on the red side, the bottom right there, you look at equity valuations. Josh just covered that. We have some higher equity valuations, especially in that tech sector. And then geopolitical risk is not going to be too much of a surprise with some of the wars going on overseas. That presents risks that are sometimes hard to ascertain how they could come. So that's going to stay probably in the red all year, we would expect. But we do see some value international sectors starting to come back. It may have some more direction in a positive direction here this year. So a couple key things to tune in on here. Number one, the U.S. economic GDP. So gross domestic product is expected, or just think of that of the revenue of a business, the output of the country. That's our big indicator of where we're headed in a positive, negative direction, is expected to be in the 1.75 to 2.25% range. That's solid. That's a solid growth. That's a continued direction forward that we had at the end of last year. Third quarter of last year was a really big growth quarter for us, and we've seen that continuing. So that's good. Inflation is expected to be below 3%, maybe even trending down to 2%, but there's been a little bit of holdup there that we'll talk about here later. So it might be in that more 3% range. Big headlines here that's positive is the labor market continues to be strong. This is huge for the economy, and we're seeing a lot of resilience there. So that's a positive for consumers and businesses alike. When we look at the monetary policy, that is in the positive. That is often debated based on timing of what people think the Fed should do and when they should take actions to cut rates. However, it's in the positive, as in with the rate cut we saw in December, that's been positive. That's a positive direction for easing things up in the economy a little bit, albeit we're seeing some more slower trajectory of how fast those rate cuts will come this year. Initial estimates have been to see about 2 rate cuts this year. I wouldn't hold your breath. We don't know where that will be. It could be one. We'll see. It's going to be really come down to a balance between how well the inflation risk is perceived to be combined with economic growth targets. So think about that with caution. Interest rates are expected to be in the 3.75 to 4.25 range when you think about what the Fed's doing. So that they did tick up a little bit, but that's kind of where we see them holding out here for this year. And we continue to see wage growth in the U.S. economy as well, up around the 4% range. When we look to corporate profits, those are expected to be in the 10% plus range. This is really important. Remember, the value of a company that you own or a business you invest in is based on their profits. It's based on Apple's net income, their profit. So there's good business environment stance right now, economically, and the way things are going, that is going to be a positive direction for corporate earnings, which will help stabilize companies. So we do expect to see some positive movement in the equities market this year. So there's some good things out there. In general, in summary, I'd say here, there's good optimism in equities, stocks you own in your portfolio. We'll see some cautionary tales here on what will happen with interest rates. And we expect to see good labor market resilience here as we move forward. But the key themes here are going to be inflation and interest rates. And there's a lot of shifts going on politically as well that we're going to address that will have some impact in those areas. So let's take a look at the next slide here. And I want to zoom in there. If you could put your pointer on the bottom left there, we see that this is the consumer price index. So this is the inflation rates. And we saw, first of all, a continued downward trend of inflation rates. Peaked at 9, and now we're down in this 3% range, which is that's a positive thing. However, you will see a little bit of an uptick there. And we addressed this a little bit in our last webinar, where the sticky point of inflation has been housing. And housing has been challenging as is holding on to higher prices with that. And we did see some uptick in inflation here in January. So, reminder here when it comes to what happens with rates is the Fed's job is to balance unemployment, which is good right now, and inflation. And that's role is to help keep those things in balance. And so when we've seen some of the sticky inflation here, that's why you're seeing them hold back a little bit. When you see some of the headlines, they're holding back, and it's because of that upward trend right there. And so we've seen some recent developments here this year in just actually this week where we had a little bit higher inflation than expected. It was expected to be around 2.9 and it was about 3. And so that's why you're seeing them hold back and saying, hey, steady is good. Let's be cautious about rate drops too fast. Overall, though, the consensus is we'll probably see some rate cuts this year, but it'll probably be a little bit slower. Keep an eye on housing and how that goes. We'll be talking about that more as we move through the year, and that's going to be one key thing that we're going to be watching. But in addition to this inflation data, the market is reacting to all the changes going on this year with a lot of uncertainty. The markets don't like uncertainty, so you've seen volatility in the market. That's expected. It tends to be short term. And a lot of this is coming with all of the changes in the political environment with the new administration coming in. There's changes being announced. It creates uncertainty. So let's talk about that. I think this is an important thing. It's on everybody's mind. Let's dig into this in a little bit more detail.
Yeah, so this was an interesting analysis put together by the economists and analysts over at City National Rockdale. I thought it was really helpful to a really helpful way to take a look at this. So the first thing that we always want to acknowledge with anything political is that many people have very strong opinions on this, and those can be in conflict with one another. We hear opinions all over the map, and they all have validity to them. And so it's important to know that if you're looking at your portfolio, you're looking at the market, and you're looking at headlines and feel concerned, that's totally normal. It makes total sense, and you shouldn't ignore that, but you should use that. You can use that to inform how should I be responding through discussion. So getting back to this analysis, what they did was they looked at potential categories of policy change and how that might impact whether it would be a higher impact or a lower impact on GDP, corporate profits, and inflation and interest rates. Now you see higher, higher, and then green and red. So isn't higher better or worse? So let's actually dissect this using. We're not going to go line by line through this. You can pause the video here and dissect this further if you'd like to. But let's use lower tax rates as an example. So what this is saying is if the presidential administration seeks to lower tax rates, historically speaking, that tends to drive GDP and corporate profits higher. That's positive for the economy. It can also drive inflation and interest rates higher, which can be negative for the economy. So you might look at this and go, that could end up having a relatively neutral impact on the economy overall. So you can pause that and kind of apply that throughout this. And you're welcome to let us know if there's questions that come up, anything like that related to this. We're always happy to have those discussions. The big topic on many people's minds, questions that we're getting, as well as the major headlines, have to do with potential tariffs. So just looking at the impact that these might have, and then let's talk about how you ought to maybe prepare for or think about this as it relates to your strategies. So, additional tariffs. That would be negative for GDP growth and corporate profits. So that'd be negative for the economy. It could also potentially drive inflation and interest rates higher. So that would be negative, a negative impact as well. So really predominantly looking at the impacts of additional tariffs, there's nothing that expects that to drive the economy up. But the difficult thing about this right now, looking through the history of kind of what's happened even so far, you had initial rates or initial tariffs proposed, and then you had kind of retaliatory tariffs proposed, and then you had a pause on those announced as negotiations go on. It's really hard to tell at this point whether these are primarily bargaining chips or whether they're intended to go into force and be actually new long-term sustained policy. Based on the behavior so far, it might indicate more bargaining chip than policy that's intended to be implemented and kept long term. But that remains to be seen. What we would expect impact wise, let's say they do go into force and are in force for a while, we'd expect that to increase stock market volatility. It's important to remember, we'll talk about this in a minute, that we are not assuming an absence of volatility. When we look at your strategies, we are always assuming short-term volatility will be the norm, not the exception to the rule. So when we recommend strategy, we're going, would this strategy for somebody who's retiring soon, is retired, looking to pass wealth to future generations of family, or has plenty of time to let their wealth grow still, what would be the impact of short-term volatility, and do these strategies address that properly? So it's important to know that that is part of the calculus already when we're looking strategically, and that probably won't sound new. That's probably been part of conversations we've had to this point. The other thing that can be helpful to remember is that, and this is we referenced this in a prior discussion. This is the S&P 500 since 1933 and coded for what type of or what party was in the presidency at that time. It's important to remember that despite short-term periods of volatility, the market has a long history and our economy has a long history of adapting to whatever the current situation is. So we don't have good historical reason to think that based on short-term changes, even short-term volatility, that we should be making changes to midterm and long-term strategy. We should have discussions about those for sure, and integrate concerns and questions and fears that folks have. But from a historical perspective, there's a lot of reason to think, based on whatever comes next, that adaptation will also occur. And we're also assuming volatility will take place. This is a slide we've referenced in the past. Along the top is the calendar year return in the S&P 500, the US stock market broadly represented. And then along the bottom is the biggest drop that the market experienced in that same year. So looking at the last slide here, in 2024, you had positive performance. You had an intra-year decline of 10% there. So there was a period of time where from top to bottom, the market was down 10%. That's not a little bit of volatility. That's a decent chunk of volatility. So we are assuming volatility will be the norm, not the exception to the rule, and we're accounting for that in your strategies. So what does that tell us here as we kind of draw this to a close? We are always trying to look historically and let that inform strategy going forward. Investment strategy should be driven by your plan, and we should also have those what happens if expectation discussions. We are always assuming volatility will be taking place in every single year, so we're not going to be surprised by it. And then, most importantly, when these concerns, questions, whether it's economic, political, whatever the case might be, those are great things to reach out to your advising team. So we'll put a pin in it there. If there's other questions or things that we can help with, please don't ever hesitate to reach out. We are here for you. But otherwise, hopefully this was helpful, and we'll look forward to seeing you next quarter.